Hey everyone, and welcome back to another video for today. So in today's video, I do want to touch on, well, the title will say 3 specific companies to buy in September. The market will pull back. There is also that self-fulfilling prophecy, I would say, that in the month of September, it's the worst month of the year on average since 1928. I'll go over a couple of the theories behind it. If you missed it during the live stream, I'll cover it again in this video. But as you can see, tech names for 2 days in a row have been hit. But if we go back, let's say, if you look at the performance of the last month, you can clearly see that the majority of the stocks are still quite green. If you go to the year-to-date performance, I mean, can someone complain? Maybe the Apple guys can complain a little bit, Tesla as well, but all in all, and of course, these software names, because software stocks have been hit quite significantly. And I know what people will say. What do you think about Salesforce? What do you think about Adobe? You know my thoughts also with ServiceNow. Quality companies that are, in my opinion, very cheap. The thing is, do I need exposure to those names at the moment? Probably not. But I personally don't see how you lose money with Adobe, Salesforce, and ServiceNow at these prices. But in this video, I do want to touch on this whole theory behind don't buy in September, or actually, maybe you should be buying in September if September is the worst month of the year. Maybe there are some buying opportunities, just like right now. I think there are some buying opportunities. If we go and look at the watch list right now, at the time of making this video, you can see that Oscar is down 7%, Zeta is down 6%, Intel is down 6%, Palantir is down another 5% or so. The only names that are green at the time of making this video is New Holdings, HIMS, and Iron. A lot of red action right now. And again, that doesn't mean that it is a must buy at the moment. Some of these stocks, yes, over the last couple of days are down 10, 15, 20, 25% or so. It's always healthy to have certain pullbacks during a bull run. You cannot go up and up and up without having healthy pullbacks. I do always invite healthy pullbacks. It's also a nice opportunity for us to accumulate more shares, open up maybe new positions. I've already bought a couple of shares today, bought more Rocket Lab, bought more Nebius, and bought more Oscar Health as well. And I'll explain throughout this video why that is. If you enjoy this type of videos, hit all the buttons, especially notification bell, so you don't miss any of the future live streams. And if you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/coachinvestor. Thank you very much. So let's first talk about the September effect. Why is September historically the worst month for the stock market? Now, if we go here and look at the S&P 500 average monthly return since 1928, you can clearly see that the month of September has been by far the worst month. Now, on the flip side, this means that buying in September is always a smart thing to do, because 4 months in a row afterwards, on average, the market had, or the S&P has been green, right? October is green, November, December, and even January. You have a tiny pullback here in February. All in all, when you see a big opportunity based on the average returns here, when you see an opportunity to buy or accumulate more shares, you better take it, right? The data just backs it up. Now, there are a couple of theories out there that explain this thing. So one, portfolio rebalancing and tax loss selling. Makes sense, especially during extreme green years, right? For the last 2.5 years, markets have been green. So yes, there is tax loss harvesting. Makes sense. It's always at the back half of the year. Okay, so that's theory number one. Theory number two, behavioral biases and investor psychology. They say here, they talk about the post-summer reality check and the end of summer optimism. Now, to be honest, this year specifically, I don't think you can compare it to any other years. You have a year of, well, tariffs, right? The tariff stories dominate the market, the news. High interest rates. Are we getting rate cuts? Are we not getting rate cuts? Who knows? You have this whole AI story happening as well for the last 2 years or so, maybe 1.5 years. It's accelerating actually. So I don't see this fitting the bill for 2025. Then economic factors and business cycles. This I can agree, especially if we do get interest rate cuts or if we do not. Currently, there's a very high probability that we are getting a 25 basis points cut in September. It sits at around 82% probability of that happening. So of course, that could impact the month of September. And then one of the last one here is the back to school effect. I laughed about this with Jose during the live stream. I don't know what the heck this means. Reduce consumer spending and then business cycle shifts here as well. I mean, we've been talking about consumer spending and business cycles for the last couple of months, but it does seem like most of the companies do say that we are still seeing a healthy trend, I'd say. And the last one is definitely the one where I'd say it's probably this. It's the self-fulfilling prophecy. The more that investors expect September to be a bad month for stocks, the more they act in ways that make it come true. But it also can, I mean, you can play the reverse Uno card, right? It's everybody thinks that September is going to be a bad month, and so they front run the news, which makes August a bad month, and suddenly maybe September a better month. But at the end of the day, investing is really not that complicated. You buy good companies at good prices and you sleep well at night. If you see good opportunities, just act on it. I'm not saying that you should always, right? If there is a dip, you should always go in, all in. No. You have time. Dollar cost average. You can average down if you like that. You can definitely average up as well. Nebius being one of those examples, and I've explained this a couple of weeks ago when they reported earnings, and I bought shares even after the earnings pump. I said, look, I like this company a lot, I like the commentary a lot, and I am willing to average up because the company is just getting better and better, and I do not care about my cost basis. My cost basis is still very, very low. My goal here is to accumulate as many shares as possible. I've done this with Nebius. I'm doing this as well with Rocket Lab here, for example. Rocket Lab is a very interesting situation right now because we are just here at around the 50-day moving average. Of course, during the day, we did go a little bit lower. Let's see if we can close out above that. There are many other examples. For example, HIMS. I do not own the company, but here you can see HIMS did go just under the 200-day moving average. We did see a little rebound. And with HIMS, you can see that historically, this is a company that does respect the 200-day moving average. We might go down under it for a couple of days, but historically, it does rebound quite aggressively afterwards. Another company I added a little bit more today is Oscar. Oscar is still down 7.4% at the time of making this video. This is also a company trading at around the moving averages, basically all of them, the 200, the 50, and the 20-day one. The list can go on and on. I still think that Zeta is very attractive. I still view this as a cheap company that is growing fast. If you want to learn more, I made specific videos about Zeta here as well on a technical basis, for example. It's also went under the 20-day moving average, and now it did recover a tiny bit. Of course, by the time this video goes out, a lot of things can change, but my view about these companies and these stocks will not change in a couple of hours. PayPal is one of those stocks where we're now down 1.1%. I did buy call options $100 March 2026 and $120 January 2027 to free up a little bit of cash. I know there is a lot more risk having call options than just holding shares, but that's why I made them not that huge positions, and I still hold some shares there as well. Iron is one of those companies that I own in the speculative portfolio, let's say. It's a company that will report earnings next week, and I do think out of all of the Bitcoin miners turning into AI plays, I do think that this is the one that is very well positioned to win a huge contract in the future. We've seen Wolf win a big contract. We've seen, of course, Applied Digital win a big contract in the past with CoreWeave, which is why we've seen the stock pump so much. And yeah, I mean, the list can go on and on. I can talk about a lot of other companies. For example, AMD. AMD did pull back a little bit more here, like I said in the live stream. I think if it enters 140, 150s, maybe I'll start adding a little bit more with regards to Uber. So yeah, there are always opportunities in the market. SoFi is a very big position for me, so I'm in no rush to start accumulating more and more. I did buy actually, I think, after the last earnings report. So when we saw the stock dip after the offering there as well, people were freaking out. Okay, that was a good opportunity, in my opinion, to add a little bit more to my position. But yeah, take these opportunities, because if we look at, let's say, the S&P 500 over the last couple of years, we've had a lot of pullbacks over the last couple of years. But what has happened? What has happened afterwards is we always went higher and higher. And even now with this tiny pullback that we're seeing right now, right? We also had, by the way, this pullback at the end of July. did recover quite quickly. Now we have another very, very small pullback currently of around, what is it, 1.5% or so for the S&P 500. But again, this is for the S&P 500. There are a lot of stocks that are down already 20%, 30%, and things like that. It's always a very, very weak argument, like, oh, the markets are still at all-time highs, so it's not worth buying anything. Well, again, I'm not buying the market, I'm buying specific companies. So if I go back to the example of HIMS, right? HIMS, for example, HIMS is down around 14% over the past 2 weeks and a half, almost 3 weeks. While the market is only down 1.6%, this name is down 40%. Again, I'm looking at specific companies here. I'm not looking to buy the market. Google, of course, we've seen a nice V-shaped recovery here. Right now, we are still waiting for the DOJ conclusion. Also today, there is the Pixel event. I'm very excited for that. I do think, and Google is starting to play in the background right now. That's quite interesting. But
April 21st, 2025 to determine penalties, with a ruling expected in August 2025. In a separate case, a court ruled in April 2025.
Okay, that was strange. But anyways, there are a lot of names. There are a lot of names that I still view as very, very interesting, very, very appealing to add even more. I will say it time and time again. I'm not going all in. I have time, I have cash, but there are definitely some names that are getting or have always been very interesting. But as I said, I rather buy during red days than green days. It's very, very simple. You sleep much better like this at night, knowing that you're buying good companies. You can buy more shares for the same amount of money. So all in all, that's about it. That's the lesson here. September might be the worst month on average historically, but in my opinion, that's just a great opportunity to buy, right? I don't know why people freak out. I'm like, oh, you're saying that historically this is the worst month, and then the months after that we're going up historically on average. So you're basically saying that September is actually the best month to buy good companies. Pretty simple, right? Pretty simple. Last thing here, I am starting to look into this company right here. A company that owns and operates franchises tea house under the Chaggy brand name in China and internationally. This is a company worth $4.2 billion, generating quite a lot of revenue, and it's already very, very profitable as well. You might say, yeah, but it's a Chinese company, smells like Luckin Coffee, etc., etc. I will dive a little bit deeper with this name. I do not own it. I do not plan on opening a position anytime soon, but this is a name that a lot of my subscribers, viewers have been telling me to look into it. So I'm looking into this name. It's very, very interesting. I mean, top and bottom line growth here, very, very impressive. So all in all, that's about it for me in this video. Let me know what you've been buying or what you plan on buying over the next couple of days, next couple of weeks down in the comment section below. And I'll see you all in the next one. Bye-bye.